7%. That's the average pullback for leading AI infrastructure stocks over the past few weeks. This isn't just noise. It's a clear signal for investors who've ridden the AI wave, suggesting a significant capital reallocation is underway right now. The AI sector has seen tremendous growth, with NVIDIA, the leader in AI computing hardware, witnessing a 50% year-over-year surge in revenue. Similarly, Alphabet's DeepMind, a pioneer in AI research, has been valued at over $100 billion. Meanwhile, companies like C3.ai and Palantir, which provide AI software solutions, have seen their market capitalization more than double in the past year. The recent pullback in AI stocks is a sign that investors are rotating out of the sector and into other areas of the market. This rotation is not surprising, given the high valuations and rapid growth of AI stocks. The S&P 500 has seen a significant increase in the number of stocks with high price-to-earnings ratios, with many AI stocks now trading at multiples of 50 or more. As a result, investors are looking for alternative areas to invest, such as the healthcare and consumer staples sectors, which have historically provided more stable returns. The AI pullback is also a reminder that the sector is still in its early stages of development, and there are many challenges to be addressed before it reaches its full potential. Despite the recent growth, AI adoption is still limited to a few select industries, and the technology is not yet widely adopted. However, with the increasing availability of AI-powered tools and the growing demand for AI talent, the sector is expected to continue growing in the coming years. Investors who are looking to ride the AI wave should be prepared for a bumpy ride ahead. The sector is expected to experience significant volatility as it continues to grow and mature. However, for those who are willing to take on the risk, the potential rewards are substantial. With the right strategy and timing, investors can capitalize on the AI boom and reap the benefits of this rapidly growing sector. For years, the AI revolution felt like an unstoppable force, propelling a select group of tech giants and semiconductor firms to unprecedented valuations. Investors poured trillions into companies, promising the next big leap in artificial intelligence, convinced that this sector alone held the keys to future growth. This concentrated enthusiasm created a market dynamic where almost any AI-adjacent announcement triggered a rally, often overshadowing fundamental analysis. Wall Street analysts hailed the Magnificent Seven as the market's enduring leaders, making it tough for other sectors to capture attention or capital. What we're witnessing now, however, is a subtle yet profound shift, driven by a confluence of factors, from tightening liquidity to a reevaluation of growth narratives. It's a moment that demands attention beyond the headlines, as the market begins to question the sustainability of hyper-concentrated gains. Data from major financial institutions indicates a measurable rotation, with billions exiting high-flying tech. Reports compiled by Bloomberg and Reuters reveal a clear trend. Capital is actively migrating towards sectors traditionally seen as less glamorous. We're observing noticeable upticks in industrials, select energy plays, and even healthcare, which collectively saw inflows exceeding initial projections by over 15% in recent weeks. This isn't just profit-taking, it's a strategic move. Analysts point to a reevaluation of risk-reward profiles, especially as bond yields become more attractive and the cost of capital impacts future growth projections for speculative tech. Market liquidity, once abundant, is also playing a critical role, forcing investors to be more selective and less tolerant of stretched valuations. The smart money isn't abandoning innovation, but it is certainly seeking better value and more diversified exposure. Here's what many investors missed. The AI boom's immense market capitalization gains were disproportionately concentrated in a very narrow segment of the market. While the headlines celebrated record highs, a deeper dive into the indices reveals that breadth, or the number of stocks participating in the rally, remains surprisingly weak for much of the AI surge. This narrow leadership means that when the few dominant players inevitably hit a patch of turbulence, the entire market feels the ripple effect, even if the underlying economy is robust. This lack of broad participation created a fragile market structure, vulnerable to even minor shifts in sentiment or economic outlook. True market health requires broad engagement, and for a long time, The AI narrative obscured this crucial indicator, leaving many portfolios overexposed to a handful of names. Digging into earnings reports and analyst calls, a pattern emerges. While AI demand remains strong, the immediate growth premium for specific hardware providers is moderating. Semiconductor manufacturers, for instance, continue to project robust long-term demand, but their recent quarterly guidance has shown a marginal deceleration in hyper-growth expectations for the very near term. Concurrently, traditional industrial companies are reporting stronger than expected order books, fueled by resilient infrastructure spending and a domestic manufacturing renaissance. Reports from McKinsey and Gartner have highlighted an acceleration in digital transformation beyond just AI, encompassing cloud migration, cybersecurity, and automation across diverse sectors. These broader technological shifts are creating new avenues for growth that extend far beyond the narrow confines of AI chip manufacturing, attracting fresh capital with more attractive valuations. Contrary to popular belief, this isn't necessarily a sign of a looming market correction or an AI bubble burst. Instead, leading strategists at firms like Goldman Sachs and Morgan Stanley interpret this rotation as a healthy rebalancing act. It's the market's natural way of digesting massive gains and seeking out undervalued opportunities. What's wild about this is that the rotation might actually extend the bull market rather than ending it. By broadening participation and spreading capital more evenly across sectors, the market reduces its reliance on a few behemoths. This diversification creates a more resilient foundation, allowing different parts of the economy to shine based on their own merits and growth drivers. Smart investors are not panicking. They are actively seeking out the next wave of winners, recognizing that market leadership is rarely static. Another overlooked truth is the evolving role of corporate capital expenditure. For years, tech companies dominated CapEx spending, fueling their own expansion. Now, we're seeing a significant uptick in CapEx across sectors like utilities, materials, and even consumer discretionary, driven by supply chain reshoring, energy transition mandates, and infrastructure upgrades. This isn't just about government spending. Private corporations are investing heavily in modernizing their operations, adopting automation, and improving efficiency. The implications for companies supplying these foundational industries, think heavy machinery, specialized materials, industrial software, and even advanced logistics, are enormous. These are the unsung heroes of the next economic cycle, quietly benefiting from a broader-based investment boom that extends well beyond Silicon Valley's immediate focus on AI model development. Whoever spotted this trend early is already seeing impressive gains. Looking at recent trading volumes and analyst upgrades, the evidence for this broad-based CapEx-driven growth is compelling. Industrial equipment manufacturers have seen their forward guidance revised upwards by an average of 8% in Q2, according to FactSet data, reflecting robust demand. Energy transition plays, particularly those involved in renewable infrastructure and grid modernization, have attracted substantial institutional inflows, pushing their valuations higher by over 12% year-to-date. Even certain segments of consumer staples, often considered defensive, are showing renewed vigor, driven by innovative product lines and operational efficiencies. This isn't speculative fervor. It's a response to tangible order books and improved profit margins. Wall Street's focus is visibly shifting, with research desks increasingly highlighting enabling technologies across diverse industries, not just within the traditional tech sector. Here's a crucial insight. The Federal Reserve's stance on interest rates, coupled with global inflation dynamics, is a silent but powerful driver of this rotation. Higher for longer interest rates make future earnings less valuable, impacting growth stocks more acutely, especially those with distant profitability horizons. Conversely, sectors with stable cash flows and tangible assets, like utilities or certain industrials, become more attractive in a higher rate environment. The IMF and the Fed have consistently signaled their commitment to price stability, which means liquidity conditions are unlikely to return to the ultra-loose era anytime soon. This policy context fundamentally alters the investing landscape, making capital allocation decisions far more sensitive to real returns and less forgiving of purely speculative plays. Understanding this macro shift is paramount for navigating the market ahead. Ultimately, the real alpha isn't found in blindly chasing yesterday's AI darlings, nor is it in abandoning AI altogether. The opportunity lies in understanding its evolving integration into a broader, more resilient economy. AI is becoming a utility, a foundational layer that enhances nearly every sector. The smart money is positioning itself in companies that leverage AI to improve traditional industries. Think AI for precision manufacturing, AI in healthcare diagnostics, or AI-powered logistics. This shift means the next generation of market leaders may not be the pure-play AI developers, but rather the industrial giants and service providers who effectively harness this technology to gain competitive advantages. Diversification, combined with an understanding of where capital is truly flowing, will be your ultimate edge. Don't just watch the market, understand its undercurrents. Subscribe for more deep dives into where the real opportunities lie. Leading strategists from major financial powerhouses are now openly discussing a great reallocation of capital. JP Morgan's recent investor briefing highlighted a growing consensus. The market's narrow leadership is broadening, pushing funds into areas previously overshadowed by tech's meteoric ascent. Analysts at BlackRock point to the renewed attractiveness of stable dividend payers and companies with robust free cash flow, arguing these firms offer a compelling alternative in a world still grappling with sticky inflation. It's not a retreat from innovation, but a recalibration of what constitutes value right now. The smart money understands that growth isn't exclusive to one sector anymore. It's just shifting gears. This outlook provides a roadmap for uncovering new avenues for capital appreciation outside the usual suspects. Across the Atlantic, European markets are mirroring some of these shifts, albeit with a regional flavor. German industrial giants and French luxury conglomerates are seeing renewed investor interest as global supply chains reconfigure and consumer demand proves more resilient than anticipated. Asia's manufacturing hubs, particularly those specializing in precision components or renewable energy, are also attracting significant foreign direct investment. While Silicon Valley's tech giants still